Welcome to the Stock Market Palantir. Today we are going to talk about SGBX. We're looking at Safe and Green Holdings Corp., a company that has really pulled off one of the most radical, almost stunning corporate transformations of 2025. They've moved decisively away from their legacy business in modular construction, SG Blocks, into a diversified holding company focused on, well, two of the market's absolute hottest themes, AI and energy.
And that transformation it's absolutely captivated the market. This isn't just a pivot, it's a complete metamorphosis. The extreme volatility and the recent just spectacular price explosion around SGBX, it forces us to ask, what's really powering that move?
Precisely. The central question we have to grapple with here is pretty fundamental. Is this dramatic share price increase and all the volatility, is it primarily driven by the strength and, the vision of the new management's strategic pivot? Is it the compelling AI-driven energy narrative they've built and their successful execution? I'm going to argue that the deliberate, aggressive strategy is the key long-term driver here.
See, I come at it from a completely different angle. While I'll acknowledge the sophistication of their rebranding, I'm going to argue that the primary and decisive factor in this hypervolatility is purely mechanical. It's a consequence of the stock's unique and, to be frank, catastrophic capital structure. At its core, this is a story about a microscopic public float meeting a mathematically impossible short position.
I see why you'd emphasize the mechanics, but let me just offer some context on the foundational strength of the strategy itself. Look, this wasn't just a cosmetic change. The 2025 transformation was substantive, marked by bringing in Michael McLaren, a veteran from the energy sector, as the new CEO. And crucially, this new leadership is backed by a substantial commitment of capital, a $108 million war chest in committed funding, all earmarked specifically for strategic growth and acquisitions. This is a real foundational shift.
A large number is always compelling, sure, but capital alone isn't execution.
It is when you couple it with instant synergy. The move to acquire Olanox, which brought in significant energy assets, and Mokfu, which provided industrial IoT and AI tech, well, that instantly created a unified, powerful narrative. SGBX shed its old identity as a struggling construction company and became an AI-driven energy play. And that immediately changes the kind of investor they appeal to. On top of that, management signaled profound confidence in this pivot by taking company common stock instead of cash compensation, which directly aligns their interests with shareholders.
That alignment is a good indicator, I'll grant you. But I would frame the financial reality a bit differently. The strategy, however compelling the story is currently built on top of some very weak trailing fundamentals. When we actually look at the Q2 2025 financials, the lag is severe. Revenue declines by 40.45%, mostly because they're winding down the legacy construction projects, and they reported a $4.57 million net loss. The narrative is soaring, but the financial reality on the ground is still struggling to catch up.
But that just represents the documented necessary cost of the transition, not the future earning potential.
The fundamental reason for the hypervolatility, though, it bypasses these operational figures completely, and it lies in the structure itself. It comes from the company's deliberate and repeated use of reverse stock splits, actions taken really out of necessity to keep their NASDAQ listing. They did a 1-for-20 split in 2020, another in 2024, and then the really critical one, the 1-for-64 split on September 8th, 2025.
Necessity creates opportunity, though.
The consequence of that final 1-for-64 split is the entire mechanical story here. For listeners who might not be familiar, a reverse split drastically cuts the number of shares outstanding, which boosts the price per share to avoid getting delisted. In SGBX's case, this move crushed the public flow, the shares actually available for trading, from 32 million shares down to a microscopic 503,000 shares. This tiny restricted float became a literal powder keg when it was confronted with a reported short interest of over 1.4 million shares.
And that's where the strategy becomes decisive.
The price action in October 2025 wasn't just some natural market event, it was a manufactured success. Management executed this highly targeted 6-day shock and awe PR campaign. They announced the use of AI algorithms for drilling. They set an aggressive target of 1,000 barrels of oil equivalent per day by 2026 and confirmed that high-profile one-coat partnership. This was all deliberately designed to ignite the buying pressure they needed to squeeze that trapped, impossible short position. Strategy provided the spark that targeted the weakness in the mechanics.
The strategy might have provided the spark, I'll give you that, but the sheer combustive fuel was entirely mechanical. So let's formally address our first contention, the viability of this new narrative versus the current financial reality.
Let's do it.
Okay, I have to concede that the acquisitions dramatically increased the company's holdings. Total assets grew from about $6 million to over $53 million. That's material growth. But the Q2 2025 report shows that the underlying profitability is still highly strained. We're seeing massive asset growth with concurrent operational losses. The energy assets, the 1,000 BOE per day target for 2026, those are still just projections. If the legacy construction unit keeps being a drag, how long can the market really ignore the cash burn in favor of a future story?
I'm just not convinced by that line of reasoning, because the market is inherently forward-looking, and, sophisticated investors understand sunk costs. The market knew the transition would be messy. More importantly, the financial structure of these acquisitions shows truly sophisticated management. SGBX acquired New Asia Holdings using non-voting convertible preferred shares, not cash.
That's a crucial technical detail.
It is. It was a financially astute move. It allowed them to pay for the assets with stock paper, so they avoided immediate dilution of common shareholders, and they preserved that vital $108 million cash reserve. This means the war chest stayed intact to actually scale the new business, these distressed energy assets, and leverage them with their new tech. They didn't just acquire assets, they preserved the capital to grow them. They're managing the liabilities while preserving the ability to execute the vision.
I'll grant that it was a shrewd maneuver for capital preservation, but preserving cash doesn't immunize the stock from the structural volatility that was already baked in. Let's shift our focus to contention 2, the deliberateness of the market structure itself.
So was it a brilliant plan or just a necessary evil?
I argue the microfloat was an unintended, self-inflicted wound from serial necessity, that constant need for NASDAQ compliance. It wasn't strategic genius, it was structural fallout. And the market action that followed proves this was chaos. We saw a day in November where 71.1 million shares traded hands.
A phenomenal explosive volume day.
But let's put that in context. If the public float, the total pool of tradable shares, is only 503,000, then on that single day, the entire public float turned over 141 times. That level of volume relative to the float, it cannot be justified by any rational valuation based on strategic merit. That is the undeniable signature of mechanical chaos, of pure, unadulterated, forced short covering.
Okay, I will concede that the splits were initiated for compliance. That's undeniable. However, management intelligently utilized the resulting structure. They recognized that this structural weakness, the microfloat, could be turned into a weapon. That October PR campaign wasn't just generic news flow. It was narrative warfare, targeted press releases announcing the AI, the concrete 1,000 BOE per day goal. The contrast with major players like AWS. They were deliberately shining a massive spotlight on a stock where shorts had created 2.8 shorted shares for every one actual available share. The strategy weaponized the mechanics, and it forced the squeeze.
That is a compelling point about the PR timing. But your argument relies on the price spike being proof of the strategy's success. That spike was already preloaded by the mechanics. To shift just slightly, let's look at contention 3, the unusual role of retail investors in this whole thing. Because if management was truly aiming for a massive, strategically controlled squeeze, they missed a key ingredient.
The uniqueness of this situation actually strengthens my claim about targeted institutional strategy. The price explosion happened without the usual, significant, coordinated involvement from the massive Wall Street bets community or the organized ape army.
And that is the most significant finding here. The absence of that mass retail coordination proves this is a pure, more mechanical phenomenon. It's driven by institutional shorts covering a mathematically impossible position, triggered simply by any sustained buying pressure, whether it's from management's PR or some outside buyer. The fact that management's PR provided that ignition doesn't make the ignition the ultimate driver of the explosion's size.
I have to disagree on the weight you're giving the ignition point. That purity, the fact that it wasn't some viral meme-driven event, it lends more credence to the strategic ignition by management. They didn't rely on unpredictable outside forces. They lit the fuse themselves, forcing sophisticated funds to cover a position where they were documented to have borrowed and sold shares that physically did not exist, what the company itself called illegal naked short selling, and then went and hired Share Intel to prove it. That is a direct, strategic confrontation.
I agree the absence of retail is profoundly significant, but I warn that this means the situation is an even greater tinderbox. For clarity, when we say the short interest is 281% of the flow, it literally means the market has traded away far more shares than exist publicly. This is just a massive open liability.
A critical liability, certainly, if a legitimate large-scale retail surge does discover this documented impossible short position. With the volatility, the management fight, the aggressive narrative, the resulting chaos would completely eclipse any strategic narrative. It would cement market mechanics as the ultimate and uncontrollable driving force. The market would trade purely on the structural dislocation, ignoring the energy target or the AI story completely. The structure provides the volatility ceiling, not the strategy.
But whether the ultimate explosion is caused by management or discovered by retail, the essential initial catalyst, the successful strategic pivot into a more modern business model, was the key. No one squeezes a modular construction company. They squeeze an AI-driven energy play with $108 million in cash. And no strategy could generate that level of volatility if the underlying capital structure wasn't already primed to explode because of those serial reverse splits.
Ultimately, I still maintain that the successful pivot, the new leadership, and that aggressive targeted strategy provided the necessary ignition to turn the company's compelling story into real market action and justify a forward-looking valuation.
And I maintain that the ignition would have just fizzled. The stock might have slowly appreciated, perhaps, if the market mechanics hadn't already created a physically impossible short position against a microscopic float. The extreme volatility we saw is fundamentally a function of a broken market structure, not intrinsic value or strategic execution, at least not yet, given those Q2 losses.
I think this analysis really illuminates that SGBX is a true perfect storm. You have expert management's aggressive strategic narrative meeting a historically tight and shorted capital structure, creating this collision that's critical for any investor to analyze. The company transformed from a struggling construction outfit to an AI-driven energy enterprise with a substantial war chest, but this narrative was deployed into a stock structure that was already hyper-volatile. The October PR campaign successfully weaponized this, leading to that massive short squeeze. Understanding this dynamic, the duality of strategy and mechanics, is essential.
Yeah, this collision of a sophisticated narrative and just chaotic mechanics is the key to understanding the stock's future. It's a question of whether it continues to trade on its potential or eventually falls victim to the structural imbalances created by years of reverse splits and concentrated short positions.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.